All right. So why don't we go ahead and kick off our third and final panel, hear from the participants. So as co-moderators, again, the theme of the day is SEC CFTC collaboration. We're rejoined by former CFTC Chair Chris Giancarlo, and we're joined by former SEC Chair and founder of Paredes Strategies, Troy Paredes. So gentlemen, take it away.
All right, thanks everybody. Looking forward to another lively discussion here. So Chris and I have the great pleasure to co-moderate today's panel number 3, which is focused on how regulatory harmonization could increase choice for market participants and reduce costs for investors, building on a lot of what has been covered on the first 2 panels. So what I'm going to do, just to kick us off, I'm just going to do a 2-second intro of each person, very distinguished backgrounds, but I'll just give a quick name, title, affiliation, so we can all orient ourselves, and then I'll hand it to Chris, and we'll go from there. So today we have, and I think I got the order right, we have Stephen Berger from Citadel, Managing Director of Government and Regulatory Policy. And apologies if I get any names mispronounced here. I know I got your name right. We got Ryan Levar from WisdomTree, Chief Legal Officer and Head of Business and Legal Affairs, Digital Assets. Nick Lundgren from Crypto.com, Chief Legal Officer. JB McKinsey from Robinhood Markets, Vice President, General Manager, Futures and International. Dave Olson, Jump Trading Group, President and Chief Investment Officer. Sonali Tyson, Global Head of FIC Electronic Trading and Market Strategic Investments at Bank of America, and Brad Tolley, JP Morgan, Managing Director and Global Head of Corporate Derivatives and Private Side Sales and Head of America Sales. I hope I got all of that correct. Anybody can correct the record if I got anything wrong. So before I hand it to Chris, let me just make one quick perspective thought from my perspective. One of the things I think is so interesting about this particular day and the roundtable is there was reference to the last time there was a roundtable like this between the SEC and the CFTC, and it was around Title VII of Dodd-Frank, and I happened to be at the SEC at the time and recall just one, the rarity of those things occurring, and number two, the benefits, and sure, we can talk about the big picture benefits and all other kinds of ways to try to facilitate harmonization, but sometimes just getting folks together can actually serve a real beneficial impact. So I very much commend Chairman Atkins and Acting Chair Pham for their leadership in terms of today, and I know from what they've said publicly, their prioritization of the efforts towards harmonization. The other quick thing I would note, which is more on a substantive front, one of the things that I find just so fascinating about the whole discussion around harmonization and the 2 agencies is, and I'm going to way oversimplify here, but just for the sake of brevity, one way to think about their respective jurisdictions and markets and the like is from the perspective of the underlying authorizing statutes, rules, regulations, and I won't go through the list, but if you take a list of all the different kind of acronyms for SEC market participants and then compare all the list of acronyms for CFTC market participants, that is a way. You're thinking about it in terms of regulated status, for example, under whether it's the federal securities laws on the one hand or the Commodity Exchange Act on the other. That is a way of approaching things. Another way of approaching things is to focus, and again, at the risk of oversimplification, on the economics, on the markets, on the risks and the exposures, and what it is that market participants are looking to achieve or what it is they're looking to avoid. Now, one would hope that all that eventually lines itself up, but those are 2 different takes. And so to that kind of recognition from my perspective, thinking about harmonization and how it maps to those considerations, I just find to be a fascinating topic. So with those preliminaries out of the way, Chris, why don't I hand it to you?
Actually, Troy, I'm going to actually pick up on that concept you introduced with an anecdote as a way of introducing our first discussion point. Before I went into serving in government, I was one of the principals in a a firm that was an interdealer broker on Wall Street. That was a firm that helped major financial institutions trade between each other. You might say we were an exchange for things that didn't trade on a regulated exchange. And in our case, one of our largest product areas was in the area of credit default swaps. About 2/3 of the credit default swap market traded through our platforms here in the United States and around the world. Prior to Dodd-Frank and prior to the financial crisis, all of those swaps traded on in cohesive liquidity pools. They were not separated out. There was no separation between broad-based swaps and single-name credit default swaps. They traded together. There might be a Latin American desk or a North American desk, but they traded in one liquidity pool. Well, along comes Dodd-Frank, and Dodd-Frank suddenly announced that our business, which antecedents went back over 100 years, was a swap execution facility. A nice made-up name. It's somewhat describe what we did, but anyway, that was our regulatory classification. But more importantly, it divided swaps up into narrow-based swaps and broad-based swaps, subject to separate regulatory schemes and subject to different self-regulation. Some of our brokers now were NFA regulated or registered, some were FINRA registered. And what we had to do was separate those liquidity pools into separate desks. So, of course, it seemed like a good idea at the time to Congress, as the Ag Committee and the Banking Committee are trying to reach a compromise, but it had real world effects, not just on our platform, but more importantly, the market participants that traded in our platform suddenly didn't get the benefit of a cohesive liquidity pool, but liquidity pools, to your point, Trey, that were divided into separate areas. So I think it was Terry Duffy on the last panel who said that what we always need to do is focus on the patients. Well, today we have the patients. This panel is the patients. This is a panel of market participants. And it, like the last panel, it's diverse. Some of the market participants on this panel are really concerned with wholesale trading, as my firm was. Others are really focused on the retail side. And so it's really an opportunity now to dig into what ultimately we're all here to focus on is how do market participants participate in these regulated markets, and how do they navigate the differences between the rulemaking of the CFTC and the SEC, and hopefully maybe we can find in our conversation this afternoon ways in which those differences are not so distinct as to separate liquidity pools into separate silos. So with that, I'd like to kick off and just talk about, if we could, and maybe we'll start with Stephen down the other end of the table and work away this way. What are some of the issues that the lack of coordination or simply the regulatory structure inherited by Congress, by the agencies, impose on the markets and ultimately the clients that you serve?
Thank you. And look, I'd like to start by just first thanking Chairman Atkins, Acting Chairman Pham, and the SEC and CFTC commissioners and staff for organizing this afternoon's landmark discussion. And thank you to Chris and Troy for moderating and for your past invaluable service at both agencies. I applaud the SEC and CFTC harmonization effort to, quote, reduce unnecessary barriers, enhance market efficiency, and create space for innovation to thrive. And I concur that we have a generational opportunity here to further strengthen the preeminent position of U.S. capital markets for both investors and issuers, and to pave the way for future market evolution, integrating new technologies into our markets and unleashing innovation with respect to new products, innovations in trading, clearing, settlement, transparency, and collateral mobility. And we can achieve this without either the SEC or CFTC losing sight of their core missions. And I think we all acknowledge that in furtherance of those missions, the agencies still have a valuable role to play in overseeing both existing and nascent markets. Now, look, I think it's clear from the historical context we heard earlier why there are separate SEC and CFTC regulatory regimes for the securities markets and for the futures and swaps markets, respectively. But it's clear also that as these markets have grown and become more integrated, and as market participants have innovated and diversified to better serve issuers, investors, and hedgers, we've all witnessed how duplicative, inconsistent, or contradictory frameworks have hindered growth, innovation, and competitiveness, and acted as a de facto tax both on issuers and investors. So, to your question, Chris, for example, Investment funds are subject to overlapping registration, record keeping, reporting, and exam requirements. I think Commissioner Ueda did a good job of highlighting some of those just now. Intermediaries are duly registered as broker dealers and FCMs, and in some cases as both swap dealers and security-based swap dealers, which comes with their own slew of overlapping and often contradictory regulatory requirements. Providers of clearing services have to navigate multiple regimes. DCOs on the CFTC side and clearing agencies on the SEC side. I think it's wonderful news that we have ICE and CME entering the market to provide clearing services for U.S. Treasuries, for example. Having the two strongest futures exchanges in the United States coming into that market is a great development. But it pains me to hear that there was a 6-year effort that was a false start in that front, and that was a squandered opportunity. And then, Chris, as you just noted, we have illogical splits in the rules and oversight of markets that are otherwise economically unified. So swaps versus security-based swaps, most notably in the credit space, is an excellent example of that. Cash treasuries versus treasury futures is another, I think, notable example. And I guess I would also like to point out that we shouldn't lose sight of the fact that the regulatory inefficiency extends down to the SRO level as well. So some of the issues we have probably with respect to SEC and CFTC harmonization, I would argue may be even more pronounced for those of us who deal with both FINRA and NFA oversight, where we also have duplication, inconsistency, and contradictions that are arguably even worse. So just a few, like three areas I think I would highlight for where I think there's opportunities for meaningful progress. Look, the U.S. asset management sector across both traditional and alternative investment funds is an unparalleled American asset, optimizing the allocation of capital to our economy and delivering returns for investors, saving for their children's education or for their own retirement. To deliver on that, asset managers rely on the ability to invest in hedge across equities, options, futures, bonds, and swap markets. So they're investing in asset classes that fall under both the SEC and the CFTC's jurisdiction. But unfortunately, as I just noted, that's left them subject to two sets of registration, record keeping, reporting, and exam requirements. And in the past, we've dealt with that by appropriately tailored exemptions to let them fall under the appropriate regime. There's been already today good discussion with respect to portfolio margining and cross margining, where we have opportunities to improve capital efficiency and pricing efficiency across correlated assets. At the same time, historical attempts so far to bridge the bifurcated regimes have yielded at times imperfect compromises that have impaired the predictability and durability of cross-margining agreements, which is highly problematic in times of stress and can be pro-cyclical. So we should expand opportunities for portfolio and cross-margining, but also make sure that they're durable and resilient, including in times of stress. And then lastly, I think there's further opportunities to enhance the comprehensive and timely post-trade transparency that's generally a hallmark of America's capital markets. It's clearly the norm in the equities, options, corporate bond, municipal bond, and swaps markets. I think there's an interesting divergence with respect to our treasury markets, where treasury futures are subject to a timely and comprehensive post-trade transparency framework. Cash treasuries still are not. And at best, we have end of the day public reporting for the on-the-run segment of the market only.
That's Stephen, terrific remarks. Can I just ask you to put a pin in the issue of the different self-regulatory organizations? Because we're having a great conversation today about harmonization of the two agencies. And yet, do we need to have another conversation about greater harmonization between NFA and FINRA? And what are the areas where a firm like yours that's so comprehensively regulated faces challenges with the different self-regulatory structures that those two organizations present? Could you just comment on that briefly? And then go to Ryan.
Yeah, sure. I mean, I think it manifests itself as I alluded to, both with respect to investment advisors and investment funds who will end up having to deal with both FINRA and NFA. With, again, with respect to registration, record keeping, and exams. And then it manifests itself on for duly registered BDFCMs as well. So it's, I think there's already a healthy discussion about the amount of the functions that have been handed down to the SROs from the agencies themselves. But I think, to your point, there's even less perhaps coordination that occurs at that level. And we're also sort of in the process of potentially putting even additional products and asset classes under the jurisdiction of these SROs moving forward. So I think we should be cognizant of that lack of harmonization as well.
And in my question, I didn't mean to in any way indicate that they're not forward-leaning on this. Certainly, in my experience working with NFA, they've always been very forward-leaning. But I think this new initiative toward greater cooperation is going to present some workload for them that perhaps it hasn't been in their wheelhouse so far. Ryan, do you want to comment on some areas in which the degree of harmonization or lack of harmonization has been challenging for you and your customer base, much more retail oriented?
Yeah. So yeah, it's funny because I was really going to focus on my example of 4.5, which Chair Ayuda certainly spent some time on before the break. But echoing that, as a registered fund provider, that then has funds that invest in commodity interests, and then having that CFTC overlap at the time, it really did create two bifurcated regulatory regimes that needed to be complied with. So, personnel costs and the like. But Commissioner Ueda really spent a good time, I think, talking through those issues. So I'll maybe pivot to kind of another topic, I think more recently, is really just the jurisdictional divide between the SEC and the CFTC on digital asset classification. So as we think about that, it comes up in a couple different contexts where, if we're trying to launch an exchange traded product that's holding a digital asset, we have to ask ourselves, are we going to end up, as a SEC registered 1940 Act fund, which typically invests in securities, or might it be a 33 Act only registered product, which is holding typically commodities? And so even to this day, we're still looking at assets, trying to do an analysis to really understand what bucket does that fit in. Under the prior regime, it was the SEC looking at really those assets and saying nearly every type of asset in this category would be a security. So that made it even more challenging. I think we're starting to get more clarity there, but that's a challenge. And then as we switch to, or also we're focused on really tokenized assets. So not digital assets themselves that are sort of native crypto to, say, a blockchain like Bitcoin or Ether, but instead tokenizing real world assets, whether those are funds or commodities or the like. And so even particularly under the prior administration, there could be some challenges there. And really, is that tokenized assets that might generally look like a commodity, is it in fact, or not in fact, but is the view being taken that that's in fact a security? And so that was challenging, really trying to really navigate those two different regulatory regimes to try to land in the right regulated product structure. So I think looking at the history, that's certainly been a challenge. I know spend a little bit more time moving forward here in a second, but I'll stop there.
Hey, Ryan, just to stick with you for a minute, and then Nick will come to you. But just Ryan on that, just to bring it to life, in terms of the regulatory analysis that you've had to undertake for the reasons that you've mentioned, in a word or two, what are the practical consequences of having to undertake that analysis by way of time, expense, delay, things that, even if you don't get the particulars, haven't come to market, that could have come to market if they were different? How does this manifest itself in terms of the impacts?
Yeah, well, it's a great question because, I think one of the challenges is, if I just take it from the SEC's perspective, going back a year and more, in terms of characterizing, you're dealing with a 1940s court case, Howey. You're then dealing with a multi-30+ prong sort of investment contract framework. You layer on another case called Gary Plastic. You could really trying to look at 30 to 40 factors to say, is this asset not a security? And so it was really hard if you're looking at 30 factors, any one, I think the prior staff would say it might be dispositive. It's really tough to then, sort of live in that environment. What does that mean then? You really want to stay on the right side of that asset characterization. It's a commodity, but you're spending time and energy on legal counsel. I mean, approaching for maybe one asset, 6-figure legal analysis memorandum that ultimately you can either go to the staff with or for your file, and that takes time, energy, staff to really all you're trying to do is make sure you're on the right side in the right bucket. So very time consuming, very costly, and ultimately, delaying the launch of a product to make sure you have characterized the asset properly.
Nick, your firm is in a different business than Wisdom Tree. What's your perspective?
Well, first off, it's definitely a privilege to be here. I'd like to thank Chairman Pham for having us here and Chairman Atkins as well for setting this up and hosting us. I think we're in a different boat as Crypto.com. I'm our chief legal officer here. I'm also president of our CFTC derivatives platform and FINRA broker dealer. I think when I think about things is, 8 years ago, there was this very forward-leaning regulator called the CFTC that actually approved the Bitcoin futures contract first and foremost. And I was sitting in-house at some publicly traded company doing e-commerce and payments. And I said, you know what, things are going to change in the United States. Things are going to change when it comes to finance. I want to get started in this. And so I joined a law firm, started practicing with cryptocurrency. Crypto.com was one of my first clients, and I came in-house about 5 years ago. I'd also like to thank Chairman Gary Gensler for making me invaluable to Crypto.com. It was an incredible thing for me. But the way we looked at it, though, is we said, okay, why and what do these frameworks exist for, and what time period were they designed from? And what we came down to is, how could a token itself be a security? And I think the SEC has since come out there, and I want to commend the Chairman Atkins and the task force for pushing this forward. They have since come out and clarified, of course it can't be. It's just code. Why could that be an investment contract? If there's no contract, if there's no investment of money in a common enterprise, it cannot be a security. Since then, I think we've seen the CFTC not just take over what was predominantly a derivatives market, but start to exercise their spot market influence that's in place to prevent manipulation from occurring. And I think that this is where Crypto.com has positioned itself on a regulatory front. I don't think many people know here. People think crypto's unregulated. We're looking for market structure. Crypto.com is a registered futures commission merchant, a designated contract market, a derivatives clearing organization, a FINRA registered broker dealer, a qualified custodian, a money transmitter, and a registered money services business with FinCEN. We hold over 150 regulatory approvals worldwide, which is more than anybody else in this room, I believe, if I'm not mistaken. All of that done within 5 years. And I want to say that crypto is regulated up to the hilt. Now, if the United States wants to be first and foremost in it, which we have the largest crypto to USD central limit order book in the world right now per volume over the last 12 months, if we want to be first in the world, we have to design exemptions that are allowing for innovation, that are safe and controlled and for the benefit of the customer. But if we're going to fall behind on this, Europe and Asia is going to come in and kick our butts on it. And I think that this is the time to do it. I think the harmonization that we've shown with everything from going from generic listing standards to get ETFs approved faster, which I think can be iterated and expanded upon, to clarifying what type of activities would constitute a security and would not, to having approvals of derivative contracts on crypto assets themselves. So we list 18 today, which is the most here. We have more forthcoming. Of course, we dabble in prediction markets with, calcium poly market and apparently CME now. But we're here to do all asset classes. And I think as we move towards the tokenization of equities, towards 24/7 trading, that is a must. Now, I heard one of the other participants say, 24/7 trading, like it'll affect deliveries. Well, just don't make them 24/7 then. Have them for the asset classes that you want, for the contracts that are supported. And I think that there's a defined framework that'll work here. So I do think the harmonization is there. To my colleague's point over here, Steve, I believe FINRA and the NFA could work closer together, especially when one entity holds dual registrations like ourselves. But there's room for this, and I'm glad we're here talking about it. Thank you.
So just to pick up on what you had mentioned, and we'll get to JB, you ran through a lot of different licenses or regulatory entities.
The acronyms.
The acronyms. Is there any particular experience, given your role there, and I'm sure leading those efforts, where the lack of harmonization, however broadly one wants to conceive of what harmonization is, created certain frictions and delays and time? We'll talk later about what the opportunities may be from your collective perspective, but any particular experience stick out to you?
Yeah, I think what, and this was back in the prior administration that this happened, and this has been cured since. But one of the things we ran into when we were listing our derivative contracts on our DCM was how do we get crypto derivatives listed if the CFTC doesn't have certainty from the SEC that these aren't security-based swaps and would require more. And I think that we went through a legal analysis. We spoke with Chairman Benham at the time and the different commissioners. And we got comfortable with certain assets, at least being at that time, that everybody could agree on were not themselves investment contracts. I think that was one that was cured. Another one that comes up is, in other markets, such as in Europe, where we were the first company to be MiCA licensed with an EMI and a MiFID license that's there. So we can offer a full slate of services that's in place. In those markets, you have one regulator, which I know people have touched upon, but what that's allowed is it has allowed a single point of contact. Now, I believe that the U.S. is best served by having the SEC and the CFTC remain independent. I grew up on a farm. I think the CFTC is paramount for making sure that physical delivery occurs and that commodities can be exchanged in an orderly fashion. But when it comes to the security markets, it's all about capital formation and the actual investor protection, as opposed to hedging and speculation on price of a commodity. And I think that having those two work together and yet be regulating different products gives the ability for innovation to occur within those bespoke aspects. So it is something that a roundtable like this starts, but ultimately it comes down to the staff and the participants here to really make happen.
Thanks, JB.
First off, I want to thank again to Chair Pham and Chair Atkins for having us here. As Robinhood, as I've been listening to you various panelists go through the conversations of where we think there's opportunities for us to harmonize and do better, I feel as though sometimes we take the look toward the product and we decide to regulate or develop rules and oversight based upon the product itself, right? So is it an option? Is it an equity? Is it a future? Is it crypto? Is it prediction markets? And we take these ideas where we try to pigeonhole the product as being built into these various jurisdictional oversights, even down to the state level. But at the end of the day, what we almost forget about, and started to hear it at the end of the last panels, who is that end customer? So you said to me, ultimately, who is the client? The end client is you and you and everybody out here, the person who's actually investing in the market, and what they have is an expectation to access these markets. And I think what's interesting is that if you look at a client who's coming into the marketplace, they have an expectation to log on now to a mobile device where they can open an account, understand the rules, the regulations, the customer agreements, and the various documentation they have to have, the ability to fund their account very cleanly, watch those markets trade, watch the oversight, the review of trade surveillance, and then receive conference statements, and then having a trustworthy counterparty on the other side of that. What's interesting, though, is you look at it, is the two regulatory regimes that we have today have very different rules within each one of those key steps as you work through that sort of trading ecosystem. So I think as you make a decision of where can we start to harmonize and build, I think we're taking a step back and thinking to ourselves, how does this actually affect the end customer? I think it becomes really, really important because technology is moving so quickly. So as we talked about before, pre-COVID, we did everything on paper documents to open accounts. Now everything's done DocuSign and other types of digital account opening processes. For funding, you can fund 24 hours a day, 7 days a week. Yet we still hold back on other times where we say, hey, collateral can't move if it's after the 5 p.m. Fed wire. So I think for us, as we look here, let's really think about how do we want to improve that experience? Because that end experience is going to improve it for every single person in this room. And for Robinhood, that's really what our focus is. Our focus is about making it simple, easy, and accessible to any and all people, whatever market they want to go into.
I'm sorry. To what extent has a lack of clarity between the two agencies and their regulatory structures hampered your ability to trade in markets?
Thanks, Chris, and thanks to you, Troy, for having us here. It's pretty exciting to be talking about this, just in general. I think stepping back to the original missions of both of the agencies, if I got my dates right here, CFTC was chartered in 1974. The first equity future didn't exist until 1982. So it really was the Commodity Futures Trading Commission. And now that product innovation and risk is taken in various different forms, this is an extremely healthy dialogue to have. A lot of talk about harmonization so far. Your question, if I heard it right, was on ambiguity, and they're close cousins. But I think you started your remarks by telling about your experience with securities-based swaps and swaps in the credit derivative market. I was in the credit derivative world at the same time when Dodd-Frank was being written in the subsequent period when rules were being made. And the one thing I'll say about that is there's no ambiguity. You know, if there are 10 instruments, it's a broad-based index. If there are 9, it's a narrow index and has a different regime. It's expensive and complicated to contort the organization to trade those different instruments, but you knew exactly what you were doing. I think an example of ambiguity, which is almost more dangerous than the expensive overhead that's created by disharmony, the poster child example of that has to be the debate that the SEC and the CFTC chairman were both having about Ethereum, where you had public statements just flatly contradictory to one another on the status of the second biggest cryptocurrency in the world. So unlike securities-based swaps and swaps, where you have to hire a bunch of lawyers and move desks and report differently, our reaction to that ambiguity was to say that the United States is not a viable market for us to seat our traders. And so we had not as early as Don, good job, Don, but we were early in trading cryptocurrencies, which back then just meant Bitcoin. It was the only cryptocurrency to trade. And as the market started to mature, we made the decision that all the activity that our global firm would undertake, the majority of it had to be relocated outside the U.S. So that was our response. We found rules that were not ambiguous outside the U.S., and we were able to grow that market along with the rest of the world, where we knew we could comply with the spirit and the letter of the local jurisdictions.
That's fascinating. You know, I'm glad you actually mentioned the origins of the CFTC, because both the CFTC and the SEC were born in the 1930s out of the great financial crisis, the Depression. The CFTC in 1936, the original Commodities Exchange Act, but it wasn't then created as a separate agency. It was made a bureau of the Department of Agriculture, and there it sat for the next several decades. But interestingly, the CFTC got its second birth in the 1970s, but not as a result of a crisis, as a result of actually innovation. It was the invention of financial futures that allowed the United States to go off the dollar standard, the gold standard, because people can now hedge dollar foreign exchange risk and, more importantly, dollar interest rate risk. And when that invention was created, for the first time, you had a commodity, you had a future on not something coming out of the ground, but something as an index. It was actually decided not to put this under the SEC, but to take the CFTC out of the Department of Agriculture and give it a mandate for innovation. It was felt at the time that if it was under the SEC with its investor protection mandate, this product would have never grown to be what it is today, which is the main reason why countries around the world can hold dollars and hedge their risk of holding dollars in the deep liquid markets overseen by the CFTC. So, and one agency born out of a crisis of investor harm, another one reborn out of an opportunity to create one of the most novel instruments. And now I think we're on the verge of a new set of innovations. And Shanali, I want to come to you. Now we're talking about the tokenization of not just securities, but all manner of things. We're talking about the ability to go to 24/7 trading and on-chain trading. These are a whole new set of innovation. And I think now we've got two agencies. The question is, how do they both step up to this opportunity and do it in a harmonized way? That's my question. A long-winded question, forgive me.
Terrific. Well, I want to echo my gratitude to Chairman Pham and Chairman Atkins for having me here today, and to the moderators, and also to my team at Bank of America for all the hard work that goes in every day to thinking about these issues. So I have the pleasure of working with a team that I think of our role as really future-proofing the business and sort of thinking about the term structure of innovation, what the markets are going to look like a few years from now, and then really coming back and influencing internally, externally, working with our clients to really build that. I love my role. I think it's one of the more entrepreneurial seats you can have. And I've had the pleasure also of working on, seeing both the opportunities and the challenges of modernization, serving on FIMSAC, working on the LIBOR transition, working on Dodd-Frank many years ago, working on MiFID. So globally have seen where modernization can really work, and then also some of the challenges. And so I really commend the commissions for taking on the task, because I think we all have seen in all of our respective seats that every dollar that could be saved, whether that's on tech, whether that's on legal, whether that's on capital, that's money that can then be put into the economy. That's money that can be lent. That's money for liquidity, right? Like we all recognize the benefits. So I would start by maybe just looking backwards, some of the not necessarily lower hanging fruit, but existing frictions that I think, again, the industry and the commissions are working on very constructively. We've heard a lot about portfolio margining today. And so I think, in terms of concrete action steps, I think we recognize that both agencies need to provide some sort of exemptive relief from the respective Securities Exchange Act and Commodities Exchange Act. And from there, we then also need the banking regulators from a capital perspective to acknowledge that. And if you think about just the pending catalyst, that we need to get this right for treasury clearing, for repo clearing, and for the adjacent markets of futures and interest rate swaps. This is really a four-legged stool that serves to sort of underpin capital markets globally. So I think that that's one thing, is really sequencing to make sure that not only do the agencies, but then the banking regulators as well, make sure that we have ample time to implement this and implement this thoughtfully. Two other just smaller areas that I would consider more low hanging fruit. One is cross-border, right? So the SEC treats transactions between non-U.S. persons that are arranged, negotiated, or executed A&E transactions as being subject to SBS regulation. The historical position of the trade associations, which we really support, is that this has had an unintended consequence of sort of not allowing U.S. persons into the discussion and dialogue, and that we want them to be in. I've seen sort of the frictions that this can create in-house in a large organization. We want to be the most efficient at servicing our clients and the real economy. And the last area I'd mention, again, looking backward, is around swaps reporting. So the SEC gets a lot of credit for recognizing that there's already been a regime in place with the CFTC and for offering exemptive relief, I think until 2029. I think that, just making that permanent and recognizing that, again, large infrastructures that largely work have been utilized by the industry now for several years, and making any amendments necessary rather than, requiring a new regime. So I think with a lot of these things, we have the opportunity to continue to onshore innovation. We have to service our clients. And I don't know if you want to touch on 24/7 trading now or move forward, but I think these are some of the items looking backward.
I pick up on one word that you mentioned.
Yeah.
And then we'll go to Brad. You mentioned, in addition to a lot of substantive areas, you mentioned the word sequence.
Yeah.
Sequencing, version of the word sequence. Could you unpack a little bit more what you contemplate by the word sequence and how that might be an element of harmonization when you think about it from a practical perspective?
Sure, absolutely. I think, when you look at, we've been talking about innovation all day, and markets are moving very quickly. We have new technologies, new capabilities. I would use the analogy perhaps of, a car that can go 200 miles an hour. And perhaps we want to get to a scenario in which, the roads can handle cars that go at 200 miles an hour. We need to think about the on-ramps, the off-ramps, whether or not trucks and buses are ever going to be able to get there, et cetera. So if I pivot that analogy to thinking about something like 24/7 trading, we certainly recognize the opportunity for international clients, for the retail segment that exists. The one thing, and I know this was discussed quite a bit in the last panel, the one thing I think we need to be mindful of, sequencing here is a great example, is how does the entire infrastructure and apparatus work? How does the risk management in those names work? How does leverage work? How do the FCMs and clearinghouses? Because it's not only about execution and reporting, it's about making sure that you don't have these unintended consequences. We can look at cautionary tales like Archegos, or when the Fed cut 100 basis points over the weekend during COVID, or even looking back to the financial crisis, Bear Stearns was worked out over the weekend, right? We need to make sure that we have the right protections for risk management in place to handle those types of events before we really unleash this on the market, because it is important to understand that something like 24/7 trading would not only impact the retail international customers, but really anyone with a position in those names. So what we want to avoid is any type of margin spiral or sell-off that's exacerbated in a market with really thin liquidity. So sequencing how that is rolled out, how 24/7 trading is rolled out in the context of the rest of the apparatus. Here's another example, even related to that as well, is blockchain might be able to play an important role in the movement of collateral. We're seeing a lot of experimentation and use cases that bear a lot of fruition. So perhaps, where can we get to with settlement, with collateral mobility, with blockchain for the entire ecosystem? But the important thing here is really to consider the leverage that exists in the system and all of the infrastructure, and then sequence the rollout of such innovations in a way that makes sense.
Brad, your CEO has been in the past pretty harsh on things, all things crypto, and yet your bank has been a leader in innovation, a whole range of areas, sort of under the hood. There's a lot going on. As you think about innovation, how does the need for harmonization between the two agencies affect you, and how in the past perhaps does the lack of innovation, a lack of coordination affect your ability to innovate?
Thank you. And I'd also like to say thank you to Chair Atkins and Acting Chair Pham, as well as our moderators and panelists up here. I didn't at first know where you were going with that when you were the CEO, and thank you. But thank you for the opportunity to be up here and to contribute to this dialogue around harmonization. My comments are really informed by JP Morgan's, our experience as a longstanding dual registrant and participant across swaps, security-based swaps, futures, and cash positions regulated by the CFTC and SEC. In terms of opportunities for harmonization, I can touch a little bit on innovation and technology. But as it relates to harmonization, when I look at swaps and security-based swaps, there are opportunities. We think that there are opportunities for efficiencies in the industry without reducing investor protection or market resiliency, and both of which were spoken a bit about today. Firstly, harmonization efforts around margin requirements, which we've talked about across SEC and CFTC regimes, would allow for more streamlined and efficient processes. It would allow us to reduce regulatory burden for market participants without creating additional risk. Specifically, it would allow registered broker-dealer, security-based swap dealer to apply one initial margin to swaps, security-based swaps, futures, cash positions over the same category of underlying risk, which present very similar market risks. That then enables us to continue to reinvest in innovation, invest in our clients, our infrastructure. On trade reporting as well, over the years, we've seen a proliferation of the requirements around data fields for transaction reporting, making it increasingly complex and really a costly area of compliance. While we understand, I think, the need for that data and those requirements, we believe that the SEC and CFTC could certainly review what information we believe or they believe is truly necessary for regulatory oversight and rationalize the reportable data fields accordingly. I think ultimately a more limited set of core reportable data fields per transaction could be harmonized across swaps and security-based swaps, and ultimately this leaves regulators with a more robust data set while also allowing for efficiencies in the industry. Those reportable fields should also be harmonized along with international standards, things like the CPMI IOSCO critical elements lists, to help at least drive consistency across various jurisdictions. And then I think finally, from a industry standpoint, we think we'd benefit from greater consistency across the broader range of security-based swaps and swap regimes as it relates to Title VII of Dodd-Frank. Includes things like chief compliance reports, CEFs, cross-border regimes, all of which at times feel like there's little justification for having multiple regimes to be different. And then when we think about, I think, product access, and Sonali touched a little bit on this, the lack of harmonization has created some impediments for certain investors, particularly those U.S. persons assessing or accessing international markets across foreign security based swaps, narrow equity indices, as well as deliverable bond futures. So we think some of these can be mitigated by further harmonization.
Yeah, collecting all those data fields, it's a nightmare. I mean, I used to sit with the staff and they would go through, well, we at the CFTC have 132 that we want. The SEC has 148. And of course, the overseas regulators want 227. And none of them line up. You could put them up against the mirror and none of them would line up. And it just strikes me that this is an incredible opportunity for blockchain-based, right? We have this post-trade reporting regime, which is so complicated. Once we have transactions on a blockchain, we should be able to have regulators as nodes on the blockchain monitoring transactions in real time, rather than having to rely on this whole post-trade reporting regime. Is that something that any of your institutions are looking into, that opportunity? Yeah.
Indeed, I think the industry is solving a lot of data problems using the blockchain. To those in the audience that are familiar with the way DeFi trades and the way smart contracts are constructed, you really have to have an off-chain conduit through which the data arrives into the smart contract. Smart contract doesn't know whether the Bears won or whether the Fed cut or anything else that happens in the real world. Oracles that are effectively, in a lot of cases, competitors that are contributing data from their own sources can be aggregated into these data channels. The Commerce Department just announced that it had selected Pith and others to release economic statistics of the government. We're using real-time data from Oracles to feed our trading models today. So this is an area that I think is absolutely wide open for further development.
Yeah, a lot of our questions are about issues of the past and how the lack of coordination affects our markets today. But ultimately, I'd like to see a mechanism for the CFTC and the SEC to work together to start thinking about the issue sets of the future. We're going to increasingly see whole asset classes on blockchains. And now is the time for the two agencies to start thinking about how they can act in a coordinated fashion rather than as that world already starts to develop and then they come at it with different points of view.
Chris, if I could, I want to go back to the 24/7 conversation just for a moment. And I know that Terry and others brought it up on the last panel. And the conversation reminds me of a very vivid meeting that I had when I was working at JP Morgan. And it was just after the announcement of commodity position limits on commodity exchanges. And we had the then head of the Agricultural Committee, Blanche Lincoln, come into our offices. Similar outreach where government was trying to work with the private sector to understand impacts of things. And we had our head of the commodity business there. And he started the meeting by saying, as soon as the idea was announced, not the implementation of exchange caps, he was immediately on a plane. He brought the pitch decks with him, saying that, as I recall, at least, the idea of position limits for commodity contracts on exchanges, there was some concern that sovereign wealth funds and governments were amassing too large of a position, along with counterparty concentration risk. There was this concern that the U.S. markets were being accessed.
The phrase was excessive speculation.
Excessive.
As if there's some area from speculation to excessive.
Speculators. Anyhow, the first 5 presentations that he had were a sovereign wealth fund buying grain silos in Minneapolis and selling 10,000 hectares of farmland in South Dakota, and on down the list of, okay, well, if we can't access these markets through the transparent, well-regulated, very clear, efficient exchanges, we're still going to get the exposure. We're just going to do it in a way that is outside the purview of the way market structure works. And I think with 24/7, I think Terry mentioned that if he knew a farmer or something like that would be angry if you could see the risk that actually happened on the weekend. I've got news for Terry and the farmer. Like, the risk is happening on the weekend. Just because we can't see the prices does not mean the risk isn't there. And the markets are filling that vacuum, whether it's Hyperliquid or other DeFi platforms. We've been trading 24/7 for over a decade. We started to trade listed futures 24/7 this year. This is happening very quickly. And I think the urgency we need as an industry, and I hope as regulators, to bring that into the open in the US and create the framework for that to happen is really essential.
Anybody want to jump on that? Because I think it's an excellent point. I see a lot of nodding heads. So
I'd love to say that I definitely agree with that. I think this is a no-brainer for us to do. If everywhere else in the world can do it, why shouldn't we be able to do it in the United States? That risk exists. There's a market for it. If there's not a market for it, let the people decide what they want to trade, what they want to have speculation in, what they want to hedge with. I do think that there's important industries in our country that, may not be suitable for this. I think Terry maybe mentioned some of these. Perhaps those could be looked at whether those, are excluded or prohibited initially. But I think as a whole, all contracts that are at least being cash settled should definitely be able to have markets 24/7. The crypto markets function perfectly in this way. The FX markets function perfectly in this way. I think having this available is a no-brainer for us to do.
Yeah, I mean, we've been participating in 24/7 markets, the crypto side of our business for a number of years. We obviously do 24/7 now with prediction markets. I would actually make the argument futures has been 23/6.5 for a very long period of time on the Sunday open, along with spot FX. But even now, if you look at what's happened on the equity 24/5 world, it's an incredible amount of participation is in the market. I actually think, to your point, Nick, it actually allows you to do a better job of managing your risk. When the news comes out, you can actually go and take advantage of it by hedging your portfolio or putting a risk on position. And I really do think that the sooner we move toward it, systems can handle it today. People can handle the overnight stuff. We staff 24 hours a day, 7 days a week, 365 days a year. If you call or reach out to someone on Christmas, guess what? You're going to get a response. That happens today. So I think what we really have to do is move forward with this idea of how can we take the existing legacy technology builds, enhance them to support, and then have the right oversight and reporting to be able to put it out there. Because I think to your point, Nick, and to yours, Dave, it's happening anyway. It's just getting pushed overseas. And I don't think we want to see that happen or continue to happen.
is it some of it being pushed to prediction markets?
Oh, definitely. I think that's where it's going. I think prediction markets are, I mean, I've been saying this for the last 12 months. It's the beginning of their journey, or their actually, I'll call revolution, because now you're able to, down to $1, hedge your risk on certain types of outcomes. So at some point, it's going to continue to move that way. And I think we want to get all those other marketplaces up so they can run simultaneously. So you as a user have a choice of where do you want to actually put your money or put your risk into to protect your portfolio.
So not only Nick and JB are talking about going immediately to 24/7. Does that give you, does that get the hair on your neck stand up in terms of concern?
It just goes back to my point. I think we're supportive of all innovation. It goes back to sequencing and investor protection and ensuring that we have the right safeguards. The markets today that are 24/7 or 24/5 may have different characteristics. Again, like the futures market, crypto is more macro, right? A lot of the leverage, it's just very different leverage. The leverage either sits outside of traditional financing or in the clearinghouse, right? So we just need, I think, the rest of the ecosystem before you move the market en masse to line up. Going back to that analogy of a car on the road, you want to make sure that, you know, the rest of the road can also operate safely and that we don't have unintended consequence.
Yeah, I was just going to say too, to me, it's not only about 24/7, it's also about when you're settling that trade. And so is it 24/7 with immediate settlement? I mean, that's why we're focused a lot on the blockchain and, bringing that to different assets is not only being able to trade 24/7, but then immediately settling that, which I think, if we're speaking about the end customer and benefits to the end customer, being able to complete that transaction, have it be completed in a transparent way, relatively low cost, really could bring the power to the ultimate investor.
Any other thoughts on this topic?
Just one last thought I'll add on the settlement piece. I think stablecoins are often looked to as the primary solution set for settling in off hours if the Fed wires down. They should be an effective tool in the toolbox. I completely agree with Jeff Sprecher from the prior panel that it's a weird asymmetry if you have to haircut treasuries, but people are dealing with stable coins as though they're 100 cents on the dollar cash. One of those is wrong. But I want to add that, Brad's firm has done a lot of pioneer work in this area. The ability to move actual US dollars, fiat transfer of US dollars outside of Fed hours exists today and is used fluidly in 24/7 markets already. So long as the two participants have an account at the same financial institution, subledger movement is a 24-hour capability that is out of the box, ready. We use it every weekend. And I think that as we get more of a regulatory wrapper around risk-taking settlements, possible liquidations, that should be an important pillar in the conversation.
Yeah, I just add to Dave's point about the comment around regulatory wrapper, and that I think ties with Sonali's your point around the sequencing and making sure that the ecosystem is set up in a manner to continue to support, more extended trading, and whether that's some of the clearing and settlements, whether that's the central bank facilities, which are important, I think, for managing risk. All of that we think is important, along with the cash and derivative interplay, and making sure that harmonization is there for that as well.
So to pick up on the word harmonization, since that's been what the focus has been, but to delve into that a bit more, particularly as we wind down in a bit here, the day, harmonization can mean a lot of different stuff. And implicit, I think, in the discussions have been different meanings of harmonization. And I haven't tried to catalog every single possibility, but it can be substantive rulebook harmonization. It can be about process. It can be about some other forms of coordination. It can be just getting folks together at events like this so that they get to know each other and they know who to call and know who to talk to, those sorts of things. You can imagine things along those lines and much more. You can imagine what the prospects are for a technology that hasn't been discussed as much today as blockchain, that is AI, and what it may be able to do just as regulators take greater advantage and what that might mean just generally in terms of the regulatory approach across any particular regulator's mission, but then how that can be, I'll use the word I'm asking about, harmonized across different agencies, in this case, SEC, CFTC. We can go on and on and on. So Brad, starting with you, working our way back, but certainly encourage active dialogue. You don't have to wait for us to get to you, but we will proceed if folks aren't jumping in. When you think about harmonization and the different forms it could take, right? I often think in conversations like this, all right, if I were back in my former seat, even if I wanted to do something, the question was always, so exactly how do I do it? How do I do whatever it is that I may be inclined to want to do from a regulatory perspective? So in terms of actually taking harmonization from a concept or by implication and thinking about it more concretely, what are some practical things that you, starting Brad with you and work our way through the panel, would recommend, if not that the regulators do, but at least that they consider doing, that you think would in a very tangible way help advance harmonization as an objective to meet the broader objectives that really have been a discussion more substantively of the entire day.
Thanks, Troy. So I think a few points on that. I think first, looking back in the existing harmonization of rules in place, certainly I'm sure there's some type of AI impact that could yield some results, but then also looking forward, and certainly the panels before this, as well as this, around innovation and technology and what's to come, because a concrete potential first step. And we've talked about a number of areas that we think there are opportunities to harmonize, trade reporting, cross margining, discussions around 24/7. But even just getting more of these forums and folks in the room to actually have these discussions. And, I think we would be, we would be supportive of the prior CFTC, SEC joint advisory committee that was formed in 2010 that got participants together. There's only a handful of meetings before that was ultimately done away with. And then as an active member of the CFTC's Global Markets Advisory Committee, I think we did a number of important efforts that really looked at things within the CFTC's purview that brought together market participants, that made recommendations that actually ultimately got their way to the CFTC, that hopefully helped market resiliency, liquidity, et cetera. So I think getting folks in the room to start is a good thing, and in a more formal way, we can come out of this with recommendations, et cetera.
Yeah, I absolutely agree with that. I look back again to my time on FinStack, and what a wonderful experience that was. A lot of work, but a wonderful experience of public-private collaboration. We put a lot of ideas on the table. We got some of them through, some of them are hotly debated. We got portfolio trading flags. We did aggregating treasury reporting. We started to tackle some of the topics like Adina mentioned about platforms and harmonizing platform rules. I think the more that the agencies can lean into formalizing it, not only a joint task force around all of these conversations, but then continue to invite the private sector, and as you've graciously done today, I think that's a formidable, powerful way. If that could get formalized over time in perpetuity, that'd be fantastic. And I think importantly, this SEC and CFTC are not just domestic regulators. You really set the tone for the global discussions through IOSCO, through other forums. And so I would really recommend going back to a punch list. We've heard a lot of really interesting things. We've come back to a lot of the same themes today, whether that's 24/7 trading, whether that's definitions for blockchain so that we can, move forward as an industry to properly scale. Blockchain is an area I do think there's a ton of promise, but in order to scale from, what's more R&D right now to really implementing this into the market, we need a lot more clarity on definitions, on investor protection, on record keeping, et cetera. So making a punch list of these are the topics that we need to get through, coming back then to this is the sequence in which it might be helpful to tackle it, then bringing in the private sector to say, hey, let's debate this punch list and the topics here, and come up with recommendations that then can be put forth before the agencies. I think that would be extremely powerful, and I really commend the CFTC and the SEC for working together on this. So pleasure to be a part of it.
Shelley, Craig Donahue, I think if I can paraphrase what he said before, he said that self-certification at the CFTC is too easy and too fast, and at the SEC it's too hard and too long. Do you think on that punch list could be maybe some harmonization between those two processes, and should there be harmonization between those processes?
Yes, I think at minimum discussion, collaboration, and understanding for why there are differences. Like this has been, again, a common theme throughout the day. So yes, we have seen through the years on some of these things, we moved too fast in a few things. It causes issues. We didn't move fast enough, things move offshore. We need to strike the right balance. We all know that. So I think the more you can put these things down on a piece of paper, to have thoughtful debate like we've had here today, wonderful collaborative discussion, I think it will yield great results.
I think there is some low-hanging fruit. I can think of one off the top of my head. There are definitions that regulate substantially the same behavior that there's daylight between the agencies. The one I can think of is when you are transacting in either securities-based swaps or swaps, you have to make the determination, am I onshore and therefore under the purview of the SEC or the CFTC, or am am I not a US person in this transaction and it is happening somewhere else? And see if I get this right. The principal place of business nexus, like where's the center of gravity of the institution, is the test for the CFTC. And the SEC contemplates the A&E model of where was it arranged, negotiated, and executed, which are kind of close, but not exactly the same. So I think one, I don't know if you can use, I wouldn't trust using AI for this task exactly, but you could imagine just lining up where do we have commonality of definitions, and like, let's just pick one or find a third one that's better than either or something like that. But make them the same.
Well, one of the things that I used to have this conversation with Clayton, there's the CFTC's perspective on that, on any given issue, but let's take US person. There's the SEC, but then there's the market's perspective, right? And do we really want the market to be choosing one or the other? Sometimes maybe government has to yield to what's in the best interest of the market as opposed to what maybe that one agency thinks is and so I think that's the hard issue. It goes to the point that Terry Duffy made about we need to think about the patient.
Yeah. I think all those things, they're in at least the way I think of it, in the good housekeeping. You can make everything a little bit more efficient. I'm not sure they're giant needle movers. I think the giant needle mover is, would the mandates of either commission allow for true substitute compliance, so that if you met the spirit of, take a swap dealer and a broker dealer, do you have to be different registrations? Is there, talked about the super app, is there a super entity out of which you could do multiple things? If you thought of the pie chart of folks at Jump and how we spend our day, we love trading, we love designing systems to trade, we love doing research, but we end up with a pretty big slice of the pie thinking about, okay, which legal entity can I express this risk out of? And then which banks and prime brokers must I meet with to stitch back together the regulatory structure of the U.S. into a single risk offset? That is the huge opportunity for harmonization, in my opinion.
So I think there's a couple of interesting opportunities here. And I think the first one comes down to being is, how do you get the incumbents in the markets willing to move into change? And how do you have the new entrants who are coming into markets be able to slow down as they're trying to affect change? And to me, I think this comes down to being
the latter one.
No, I know. Well, I'm one of them, so I get it. But I think part of it actually comes down to being is it's almost by it's a carrot and a stick. Do you pick a time by which we want to get to something, i.e. 24/7 trading, or to utilizing the blockchain? Well, how do you get to that point? But if there's never an actual time to which you have to do something, what do you end up doing? You just let it continue on in the status quo. So I think part of what we have to do is look and say to ourselves, what are those key areas that we really want to move toward, that we're seeing happen globally? And find a way to put a timeline to say, let's go build and let's move forward, and let those that are innovating perhaps lead the way, and those that are maybe more traditional come along the way at a slightly slower pace, still with equal opportunity and equal footing that's out there. And then vice versa along the way. But I really think if you just kind of go down, I think, to the punch list comment and to different areas, I mean, there are so many different areas that we can improve experiences for end clients and for our overall compliance group that's out there. I mean, whether you're looking at it from a product by product basis, whether you're looking at it from an operational standpoint, whether you're looking at it from AML, KYC, all of these have slightly different nuances that have impacts for us downstream. And so I go back to one of the first things I think went really, really well, which was cybersecurity. It was like the biggest concern we had out there. We're like, oh my God, what do we do about cybersecurity? Somehow both sides kind of got to the middle where we could figure out and say, we probably need to have certain protocols and oversight and reporting that makes sense if you are combined as a broker dealer, as an FCM, as a swap dealer, et cetera. I think we need to get to that same spot, but I think we also have to push ourselves to say, let's do it in a time frame that makes sense. Because I'm going to tell you, I do this internationally for a living as well. Everywhere else internationally is moving forward. And if we are slow to react, then we'll be left behind. And then the question ends up being is, how do you bring that product and those trading capabilities back on shore? It's really, really hard to once it's gone.
Maybe are you suggesting that harmonization is not just needed between the CFTC and the SEC, but maybe with overseas regulators as well?
100%. And I sit with the regulators who will ask me, well, what are you doing with it in regards to the SEC, or what are you doing in regards to the CFTC, or how does this work? Because they want to know, because they look at someone like myself, Look, we've got over 26 million individual accounts. A previous place I worked at has over 34 million. So 50 million plus people I've had to interact with. They're all different rules of what they want. They want to know how do I make it easy and simple for these people to be able to understand the risk that's out there. So why don't we take a way to bring the U.S., make it the leader like it is in the markets, but then also do that from a regulatory standpoint by going overseas and bringing those same good practices over here.
Nick, you operate globally. Is international regulatory coordination really a possibility?
Well, I don't know if it's a possibility, but I agree with JB that it would be very ideal, is the right way to say that. I think when we look at the US kind of to take digital assets, for example, there's a big attack on the industry, a few years back that has subsided. Other countries now are going to take their turn. And it's like, well, why can some asset classes be traded in one country, not the other? Yet people can freely travel, yet we can import and export goods and services from other places. I mean, many of the people that probably work at Robinhood and Crypto.com and Bank of America, they're from all over the world, right? They're helping benefit a global company. So I think that global standards is critical. I do want to go back to a few points, though, with the harmonization. So now you mentioned the self-certification process, I think, between the CFTC, which is your 48-hour window, of course, and then your securities one, which is a bit longer, let's call it. I think the reason why those do differ, and maybe it makes sense, is because these are different agencies dealing in different asset classes. One is centered on investor protection. The other one is centered on facilitating speculation and hedging that goes in for pure price discovery. And I think if you remove or at least increase the self-certification process on the commodities aspect, what you're doing is you're actually removing from the market the ability to have a contract listed and get distributed in a timely fashion, which is pertinent for commodities that are fungible, but I'd say dangerous potentially when it comes to securities that have investors that are associated with it. So I do think keeping that self-certification process that the CFTC has worked and is very vital. Now, should securities go that way, I'll leave that up to others to kind of discuss and see if there's maybe a more efficient path. But there's also, when it comes to other harmonization, Troy, you mentioned AI being used, and I actually don't view AI as maybe helping with harmonization, but it's an inevitability that's going to be upon us here. It's starting right now. There's very minimal adoption, quote unquote, for like real world use besides researching, writing papers, creation. 6 months from today, you will see a drastic change. And the only way that these AI agents are going to interact is going to be through the blockchain with a decentralized, immutable ledger that's in place. And the United States needs to understand that this AI curve that's happening right now is going to go exponential. And if we don't have it solidified for how blockchain functions and how financial services can function, which is like the bedrock of how the United States became the leader that it is today, then we are going to also put ourselves in a bad situation for when AI comes up and rises up. Other countries will pursue this as well. The United States needs to remain at the forefront. And so I think of it when I think of blockchain, it's not just crypto assets and being able to trade the fungible tokens, but it's also the tokenization of securities, of deposits, of stable coins that come out, potentially of derivative contracts, and being able to use those in a way that can become interacted with when we're all using AI agents in 2 or 3 years from today. It'll become ubiquitous, and I think it's very important. Lastly, I would
Can I just pick up on that one point?
Yeah.
How long before I can just go onto my mobile device and say, make a market on say Polymarket, for example, in whether this panel is going to end at 540 or not, and the market will be created and everybody in the room could bet on it.
Let's use Crypto.com's prediction market.
Okay, I'm sorry.
Crypto.com. On Crypto.com's, I think it'll come sooner than later. I think that being able to use an AI agent needs to be able to work within a regulatory framework. So, perhaps a contract of if this is going to end in 5 minutes, everybody wants that to happen, but we'll see if that's able. I think that you'll be able to do that coming next year.
Yeah, I was just going to mention, as we focus on the end investor experience, and Nick, you were, I think, getting there when you were focusing on, the investor wants to hold an asset, it wants to move the asset to maybe one blockchain or another blockchain, it wants to change assets from stablecoin to tokenized money market fund to tokenized gold. How do they do that? I think one word that we hear continually coming up and that we really lean into is interoperability. So when we see the world in the future changing, it's interoperating among those different either systems or wallets or assets. And really the only way to be able to seamlessly do that is through regulatory coordination, because if you're moving among regulatory regimes, different assets, different underlying technologies, the only way to really achieve that hope is through regulatory coordination, whether it's on the definitions, technology neutral, principle based. That's, I think, what we're ultimately hoping to see, as we move forward.
Brian, I totally agree with that. I think that's where perhaps an innovation exemption can come into place. This is a place where the SEC and the CFTC can say, okay, here's a defined parameter from licensees that are already overseen that you have, insight into, that you have reporting obligations of their core business, that are not just some fly-by-night actor coming out to market, with a team of one that's untested technology, come out and say, okay, we want to operate in this area. We think that there's possibility for the future to be found here. Let us do this on some sort of pilot contained limitation set of rules that are in place, perhaps restricted by jurisdiction or other type of suitability measures that go into it, but at least make it be able to happen, because this is how we stay at the forefront. And I think as we see AI converge with blockchain, converge with financial services, all of our lives will look very different 5 years from today, just like lives started to change back in the .com era. Now, there's going to be winners and losers. The incumbents, of course, will be very well positioned to take the lead early on. But I think competition's what's been bred about America and something we should continue to foster.
Yeah, and I wholeheartedly agree. I mean, if I think specifically at the SEC, I mean, that's how innovations occurred. I mean, where, bread and butter, Wisdom Tree's ETFs. I mean, the ETFs were a concept evolving from the exemptive relief. Can we even, innovate there through the technology exemption? I think is important as we move forward.
Chris, just quickly picking up on your cross-border point, it wasn't until a few weeks ago that U.S.-based investors were able to access JSCC for clearing Japanese yen interest rate swaps, even though we've had a clearing mandate in that product for well over a decade. And today, a U.S.-based broker-dealer can't clear European government bond repo and LCHSA. So certainly important issues that still need to be solved for global markets in that regard. Quickly, I just wanted to reflect on one thing from the last panel. I think, calling some of the greatest innovators in American finance old guard or legacy juggernauts is just silly. So I think we should move past that. And at the same time, entrepreneurs and new entrants are the hallmark of a dynamic and competitive market. So we should celebrate that and encourage it. I think it's quite clear that new technologies, be that blockchain, tokenization, smart contracts, et cetera, they have the potential to enhance market functioning, whether that's with respect to enhancements to clearing and settlement efficiency, collateral mobility, facilitating the ability to trade, clear and margin around the clock, et cetera. But I think as noted, any innovation exemption should really be both targeted, and it should deliver really real value for investors, issuers, and hedgers. And we need to make sure it's not a regulatory arbitrage play that empowers a select group of intermediaries to extract rents from the market. So I think the point I'd like to also close on is I think the process around this is all quite important. So I think it's great that we're having this discussion in an open and transparent fashion today. I think, we don't want red tape to get in the way of opening up greater opportunities, but we still need to do things through a transparent rulemaking process and, have everything rooted in sound economic analysis.
Thanks, David. I think that's some great perspective. I think over the decades, we see these phases of market development where we have old guards and we have new entrants into the field. They're always challenging one another. I think that's healthy for markets. I think what perhaps makes our current environment unique, however, is new technologies that we haven't seen the likes of before. Distributed ledger technology is more than just funky new asset class. It truly is a new architecture of finance that does cause us to reconsider some of the structures we built, the intermediated structure of our markets, issues like self-certification, issues like principle-based, rules-based, the structures in which we've built the financial markets. So I think it is an exciting time, and I really want to add my own personal commendation to the leadership of the SEC and the CFTC and the support they're receiving from the administration for the collaboration between the two agencies. I must say, in any era, collaboration is a good, and in this era, I think it's a must. And I hope that perhaps some of the comments that you've heard today and on the other panels lead to us taking this initiative and taking it forward so it becomes part of the daily practice of the two agencies. So I want to add my thanks to all of you for this, and I want to then ask Troy to give some closing remarks.
I'm just going to say thank you for the opportunity personally, and it's been great to moderate alongside Chris, and certainly welcomed all of the perspectives and comments, not only this panel, but throughout the day. So I'll leave it at that because I know we still have the opportunity here from Commissioner Peirce.
And I would just add, Chris, unfortunately for you, Terry Duffy got you long 540 close by way of a cow sheet. So
Paid for the nose.
yes, so you're sweating that now. So thank you, panelists. Thank you, Troy and Chris. Very much excellent panel. We have saved the best for last. Commissioner Peirce is going to join us to take us home with some closing remarks.
Thank you to all of you who were in the audience, either here in person or virtually. And I think that this has been a fascinating discussion. Thanks to our wonderful moderators. Thank you to Chris, Jill, Jamie, and Troy. You did a great job. And thanks to the wonderful panelists on all three panels. We welcome vigorous competition from old guard and new guard. But we're going to try to keep the regulatory playing field level, the barriers low, and then we are not going to put our thumb on the scale in favor of one or the other. I do want to thank the chairman of both agencies, Chairman Atkins and Chairman Pham. Thank you for doing this. I think it was an excellent day, and I'm very impressed at how quickly this all came together as well. And so thank you to everyone who made that possible, including staff in the Division of Trading and Markets and on the Crypto Task Force. In the wake of the Auburn-Oklahoma game, in which the Southeastern Conference, aka SEC, referees failed to call a penalty on an Oklahoma player's unsportsmanlike conduct, an angry Auburn fan left multiple profanity-laced messages on my office voicemail. Had I answered the phone, I would have redirected his call to the proper agency. For sports-related complaints, please call the CFTC. Drunk sports fans, though, are not the only ones who have trouble discerning which agency to call to resolve a problem. Even sober and seasoned market participants, as you've heard today, sometimes find it challenging to discern whether the SEC or CFTC is the right agency to address their issue. Blurry jurisdictional lines, petulant agency tribalism, and sometimes aggressive agency power grabs have fostered uncertainty-fueled regulatory arbitrage and impeded the efficient functioning of the markets. I'm pleased, therefore, to be here today to close out what I think was a pretty lively roundtable on SEC, as these things go, on SEC CFTC harmonization. As the panel discussions illustrated, the two agencies always have had many reasons to work together. The markets we regulate are deeply interconnected and complementary and share many common market participants. The two agencies also share a common goal of fostering a thriving, competing financial system upon which a prosperous economy can serve the nation's needs. The risk-taking and risk offloading markets that our agencies regulate are essential to economic growth. The American people deserve and expect good cooperation between the SEC and CFTC. We've not, unfortunately, always lived up to those expectations, but I think today's roundtable evidences a renewed effort to work together and to learn from one another. Good process, which I think we've heard today, we've heard both procedural recommendations and substantive recommendations, which I've appreciated. And I think good process really is key to ensuring close cooperation. Problems arise, for example, when the agencies do not talk about a new product coming to market that lies close to the jurisdictional boundary, and do not share experiences with similar rules. As I experienced directly when I worked with then CFTC Commissioner Brian Quintenz on Dodd-Frank Title VII implementation, sitting down and working through issues together is the most effective way to get the regulation right. And Chris was in those conversations as well, and I think it was because Chris and Jay decided that the two agencies would work together that we did. Those conversations were not always easy, but they were very important. The SEC was able to harmonize many of its security-based swap rules with the CFTC's already operational rules under Title VII. The Title VII cooperation formed the basis then for further joint work. In 2020, the two commissions even held a joint commission open meeting to adopt a rule on security futures margin and solicit comment on portfolio margining of uncleared swaps and non-cleared security-based swaps. The administration's efforts to develop a clear regulatory framework for crypto. This really marks a wonderful opportunity for our two agencies to commence a new era of working together. Whether under current statutes or under a new crypto market structure bill, both the CFTC and the SEC will have a role to play in regulating crypto. A new set of assets, intermediaries, and technologies demands our joint attention. We need to work together to ensure that investors are protected and that issuers of crypto assets, issuers of investment products composed of crypto assets, advisors, brokers, and trading venues know what regulatory framework applies to their activities. We should avoid duplicative regulation. For example, if an SEC-regulated exchange or ATS or broker-dealer wants to offer customers the ability to trade a digital commodity against a security, regulation by the CFTC and NFA really doesn't add anything to that. Our two agencies should coordinate to develop appropriately conditioned exemptions. Crypto issues are not the only ones, and I think we've heard a lot today on non-crypto issues, so they're not the only ones on which cooperation is essential. We should pick up the thread from 5 years ago and work on portfolio margining issues so that market participants can net offsetting positions when appropriate. We also should revisit the swap and security-based swap reporting rules now that we've had years of experience with them, and perhaps some of the other swap and security-based swap rules, and see if further harmonization would be beneficial or changes would be beneficial to either or both agencies' rules. Recently, the agencies extended the compliance date for Form PF. The SEC and CFTC, along with other financial regulators, are working on implementing the Financial Data Transparency Act. And so in all of these areas, we can work together to try to get to a better place. I think Form PF collects a lot of data we don't need. We should work together to figure out what data we actually need. With the FDTA, we can draw on our experiences with structured data and try to understand how we can get to a better place, to get to a good place with FDTA. Facilitation of new products is another area that deserves our attention. I think you heard a lot about that today. To avoid circumstances that we've seen in the past due to lack of coordination between the SEC and CFTC and the product sponsor. In one instance, relatively recently, trading in a new product was halted after it had commenced. Routine meetings and coordination between the two agencies' staff also are key to working through difficult issues such as 24-hour markets and decentralized finance. We should recommit ourselves to sharing information about the markets and the entities that we jointly oversee and conduct joint tabletop exercises to prepare for firm failures and other market events. We should cooperate in writing and implementing and monitoring the effectiveness of our rules. Coordination on enforcement matters is also important. Me Too enforcement cases are both a waste of scarce enforcement resources and potentially are disproportionate to the underlying misconduct. SEC referees have little time to make their calls on game day. We, the other SEC, has longer to make our regulatory calls. And we also have the advantage of being able to make those calls in collaboration with our regulatory colleague, the CFTC. I look forward to many such consultations in the years to come. Good regulatory calls also require close coordination and with the public, and today's roundtable is one indication of how important that can be. Thank you so much for your attention, and I hope you enjoy the rest of your evening.
So thank you, Commissioner Peirce, and thank you all for spending your valuable time with us. Again, all ideas welcome. Harmonization at sec.gov. Thank you again. This concludes the roundtable. Please stay tuned for important developments on this front. Thank you.